Good morning. Let's get our guests on. Morning, gentlemen. Thank
Morning.
you for
Morning.
joining us today. Really excited to get you on, and obviously it's as Matt was saying, it's an interesting time. But the real estate sector in particular has been sort of through this period of sort of heightened uncertainty for a while now. So I just before we get into it, just wanted to sort of go around, give you a chance to sort of introduce yourself and what the fund does. So maybe we'll start with Bradley first.
Thanks very much, Richard. I'm Bradley Biggins, and I'm co-manager of Schroeder Real Estate Investment Trust. We own a diversified portfolio of UK commercial real estate. We're focused in higher growth sectors, so 63% of the fund is invested in industrial or retail warehouse. Today, we offer a dividend yield of around 7%. That is fully covered by earnings, and it's grown by 7.3% over the last year. That's underpinned by a really competitive sort of leading balance sheet. So more than 70% of our debt is fixed at 2.5% for 11 years. So that really helps underpin our earnings, so we can just focus on growing that top line. We think right now is a really interesting point in the UK real estate sector, both for the overall market, but also for our trusts. And I think we'll get into that in a moment. So delighted to be here. Thanks, Richard.
And Richard.
Yes, I think Bradley's rather stole my thunder because our custodian property income REIT that I've been running for the last 11 years is quite similar. It's a diversified fund. I suppose what marks us out is that we buy typically smaller properties, sort of sub £10 million. So our portfolio is incredibly diverse, 150 properties, over 300 tenancies. And by focusing on those smaller properties, looking in the parts of the market where perhaps the institutional investors and those with a lower cost of capital don't look, we can drive out a higher income return. So as at today, and given the discounts that the whole market are on, our dividend yield is 7.9%, also fully covered by earnings, which we think is really important.
Cool. And Marcus?
Good morning, everybody. Thank you for inviting me onto this panel. I'm the fund manager of TR Property Investment Trust, which is a FTSE 250 listed investment trust, investing in pan-European real estate equities. We are a market cap of 1 billion, as I said. We're split roughly 2/3 Europe, 1/3 the UK. We also have the ability to have some gearing. Our maximum gearing is 20%, and we're currently at 17.5. So I'm about as optimistic as I've ever been. I've been running the trust since 2011 and been investing in real estate equities since 1999, although I'm a surveyor by training. Dividend yield about 5.5%, and currently we're trading on a 10% discount to the asset value.
Cool. Great. Thanks a lot, guys. So yeah, I think we'll get started with talking about the M&A actually. I think it's been a key subject or topic for real estate for a couple of years now, and it seems to have really heightened in the last few months. And we're seeing a lot of big US private equity funds come in and take out companies on the cheap, taking advantage of that discount that you guys have mentioned. Why do you think investors are not seeing what private equity are seeing and the value that's on offer here? Maybe we'll start with you, Marcus.
Well, it's a great question, Richard. And the answer quite simply is, real estate equities has not really been a place to make money relative to the wider equity market over the last couple of years, and particularly with the dominance of the US stock market. So we've been a tiny part of the universe and really not being able to deliver the returns that other people have seen. But that tide is very much turning. And you must remember that for generalist investors, at the end of the day, if interest rates are rising, real estate is a leveraged asset class, and we're seen as, it's an uphill struggle. So what private equity is seeing is quite simply forward-looking from here, that we're past peak short-term rate. The long end of the curve appears to be reasonably stable at the moment. Obviously, the risk to it rising in the US with tariff inflation, etc. But I think here in Europe, we probably expect that longer end of the curve to continue to drop down. So I think all that's happened is that private equity is seeing what the rest of the investment community will wake up to in relatively short order, and that is, an opportunity. Now, there are a number of companies that have reasons for trading on discounts. Some of those are to do with scale. And the fact that private equity, if you take what's happening with potentially with Warehouse REIT, where Blackstone will, have already made it very public. They have a vehicle called Endurant, which has already got 2 other listed companies in it, Industrial REIT and St Modwin, and they would be dropping these assets into that and being able to run them much more efficiently. So there is a scale point here, but fundamentally, you're absolutely right. Investors will need to wake up, or rather, we see this now as a very strong underpin for our sector, and it'll be interesting to hear comments from other managers in a moment. But yeah, that's we think it's a real opportunity.
Cool. And Bradley, you got any thoughts?
Yeah. Firstly, I'd echo that, the trade clearly has been in recent history, US equities, particularly Magnificent Seven, these very exciting growth stocks, some underpinned by the AI thematic. But as, the world is changing, I think more value-orientated stocks start to look a bit more attractive, such as real estate. But what I would add is that we have seen many investors actually recognize, I think, the value in S-REIT, certainly. So, for example, in 2024, we delivered a total share price total return of 23%, the year prior 13%. And that's because we're getting marginal buyers of stock, particularly from some smaller wealth managers, but also retail investors increasingly. They've been acquiring our shares in droves. So I think that some of the really attractive characteristics of UK real estate, particularly our trust, have been recognised. And I think that's, I mentioned this is a really exciting point for real estate in the UK. And as you've said, PE have clearly recognised that. I think what we've seen is an average decline in valuations of 25%. So that, leads you to believe it's a really attractive point in time to get back into real estate, particularly as interest rates start to come back down. Construction costs are very high. They've increased enormously over the last 4 years. So what you now see is a really thin pipeline of new stock coming through. So that means there's really good potential for positive rental growth from existing space. Rental growth has continued despite the 25% valuation decline, in stark contrast to previous downturns such as the GFC, such as the early 90s, particularly in structurally supported sectors such as industrial. And we think that's going to continue because not only are construction costs high, as I said, but vacancy for high quality space is also very low. So we're actually forecasting total return in UK real estate of 8 to 10% per annum in the next 4 years, each of the next 4 years. And that's on average unleveraged.
Cool. And Richard, so why do you think investors aren't seeing what PE are seeing?
Well, it's been well covered. I think Bradley's nailed the opportunity set that we all see in day-to-day real estate. Occupational real estate is pretty strong rental growth. I think the question as to why the wider market hasn't seen the opportunity that PE has seen, probably worth just setting out where that opportunity is. We've got a listed sector on an average discount of around 28% across all listed real estate. Most of the PE deals are being done at somewhere between 0 to 10% discount to net asset value. So there's a clear mismatch in perception of value. And I think it comes from, and Mark has touched on this, PE's forward-looking. Surely that's the right way to invest. Forward-looking, looking at the opportunity that's coming down the track, almost certainly as rates fall and this rental growth feeds in. And I think what we are missing from the demand side of the supply-demand equation that gives us stock prices is institutional demand. The institutions are just far too often backward-looking and are also, unfortunately, tied up with regulation and compliance. And my sense, having trailed around the city for 11 years talking to shareholders and potential shareholders, is that there is too much focus on liquidity and cost when they should be looking at risk and return. PE, of course, are all about risk and return. They're IRR driven, and those forward cash flows are looking very positive.
Yeah. No, that's an interesting point. So, as you said, we've seen these bids come in at close to net asset value and at large premiums to share prices, but there hasn't seemed to be any read across to the peer group and the rest of the sector. So what do you think will be the catalyst for a change in sentiment? Should we come to you, Bradley?
Yeah, clearly we need capital to flow into Europe, particularly the UK, from the US, and I think there are signs of that is happening. Certainly for us, as I said, our share price performance has been very strong actually in the last couple of years, and our discount has come in to become much more tight. So we were around sort of 30 to 40% 3 years ago. Now we're at 15% today, perhaps even tighter. At the beginning of this year, we're in single digits, actually. So I think there has been a good move inward, particularly for the diversified trusts. And I think they were a bit unloved because, clearly, again, in real estate, the trade was, industrial, for example, and the single sector specialists, if you held them, you were rewarded. Whereas that polarization in returns, where we saw industrial capital values double and retail capital values halve, we don't see it to be quite so stark looking forward. And in fact, in the last 12 months, the strongest performing sector, believe it or not, has been shopping centres. So I think that there has been a move inwards, particularly for the diversified trust, and particularly those that are offering attractive dividend and attractive dividend growth.
Yeah. And Marcus?
I'm going to be a little bit more controversial and say that when you look at the businesses that are currently, with the exception of the other names, and we can include one deals that have happened recently like Tritax, Eurobox, but as well as when we talk about Warehouse REIT and other names that are under the spotlight, strategic review at Labs, situation, internalisation, rejecting internalisation proposal at Shed, you've got a situation where there's clearly a situation where the market is not enjoying or not comfortable with externally managed vehicles, and they are being a particular target for private equity. And I think that is something that can be resolved. It's not that there's a problem with external management. There's just a problem with alignment. And I think those vehicles can help themselves by ensuring they are more aligned with shareholders. And that will probably tighten up discounts. Now, obviously not the two management teams we have here, but there are others that haven't had the track record or the experience. They've been very good at raising money, necessarily running money, and whereas both Richard and Bradley have been doing this for an extremely long time, so they're not in that particular camp. But I'm afraid, whilst I echo Richard's comments that investors need to look at risk and return and not necessarily liquidity, unfortunately, the compliance requirement does require them to look at liquidity. And what we've seen in the wealth management community is a huge amount of consolidation amongst the institutional owners of these shares. And I was with a major one yesterday, and I said, look, out of interest, if there was a real estate IPO that came sort of out of the blue, what would be the minimum size at which your particular firm could invest? And the answer was well north of 500 million. So this is becoming an issue for everybody. So for us, we think that much like if you're a pack of sheep, a herd of sheep, and the wolves are circling, then you compact together to protect yourselves. And that's, I'm afraid, what we probably need to see in our space is further consolidation to do two things: increase liquidity, increase market cap, and reduce costs. Although I know that Richard will certainly have some comments on this, but and I was amazed that he wasn't able to succeed in his last venture at consolidation. I thought that was disappointing for all shareholders on both sides of that particular table.
Yeah, well, it's funny you say that. There's been a question come up on that, actually. Do you have any further plans for mergers following the API bid?
Well, I think we've been very clear in our annual report and statements that have been made by our board that, yes, we are absolutely open to the opportunity. Clearly, I was extremely disappointed that the API bid didn't work. I think that was a shame for the sector as a whole. And I am always disappointed when I see a peer group fund being taken out by private equity, knowing the huge amount of time and effort and work that goes into getting real estate into the hands of investors. To see them get snapped up cheaply by private equity is really disappointing. And I think it was a very bad result for all concerned. There were no winners, in my view, apart from the subsequent purchasers of that portfolio. However, looking forwards, yes, if an opportunity came along, we would be there. But in answering the question, so what's going to be the catalyst to the recovery? I think it's already started. But unfortunately, we've been tripped up. We were tripped up by Rachel Reeves's budget, and we were tripped up by Donald Trump's tariff war. Because if you took those two out of the equation, the recovery started in 2024. As Bradley said, all our discounts were much narrower at the start of this year, and I don't think we had forecast, despite the fact he said he was going to do it, quite how aggressive the trade war was going to be or how volatile the outcome would make markets. But I think it started, and I think real estate is going to be a sector to watch this year. And I called it for last year, but I got it. I wasn't expecting a growth budget to be quite so anti-growth, but that's what we got. So
yeah, a couple of points there then. Where do you think, I know, Marcus, you were saying there that we need bigger funds, bigger trusts. So where do you see the market in, say, a year or 2 years' time? Do you think there's going to be a lot less trusts out there, but a lot bigger? Or where do you see that?
I'm afraid I think it's inevitable that we will see these vehicles consolidate. The key is for those whose paper is of the highest quality and the highest valuation, they are then going to be able to use that paper to acquire lower valued competitors. And the major player we've seen do this now several times has been London Metric, obviously with Mucklow, with CTPT, with LXI, and now potentially with Shed. So that's a poster child of what's going on. Now, that doesn't mean there isn't room, and there absolutely should be a room for a range of diversified REITs. It's clear that the private investor community want those. When you look at the share registers of Richard's vehicle or Bradley's vehicle or others, it's clear, and it's that high income, diversified high income is what they want. So I would echo Bradley's comments about and Richard's about, that we are at and why TR Property is so geared. We're in this very interesting situation where capital values have corrected, but rental values are growing in virtually all our sectors, bar some secondary office and retail markets. But actually the cost of construction or the cost of improving these assets is so high. And I think, REITs generally across Europe with these average loan to values of mid 30%, 30 to 35, have the firepower to continue to improve their portfolios, whereas a lot of private property companies just haven't got the money, they haven't got access to the money. Money's remaining quite expensive. So all of this plays into actually the very attractive, very secure corporate structures that the REIT market is currently offering. It's a real opportunity, and I would echo exactly what Richard said, that things have already started, and we just need the stock market slightly to catch up with that.
Yeah, and we discussed tariffs, obviously, come up a few times. Obviously, there's indirect exposure. Obviously, no one wants to see a recession and all that. So is the sector exposed directly to the tariffs? We've got a question here. So surely it's the European industrial sector with sort of exports and manufacturing possibly being hit. What are you guys seeing on the ground, Bradley?
Yeah, I mean, certainly the logistics sector is probably most exposed to, reduced exports to the US or reduced imports from the US. I still think that's going to be an attractive sector though, but it's less attractive. And I think that other investors are seeing that as well and maybe reassessing some bids for portfolios or companies in light of that. In terms of indirect exposure, it's very, very difficult to say. We don't even know where the tariffs are going to land, what level they're going to be, when they're going to start, etc. But, in S-REIT, we've got a well-diversified portfolio, got multi-let industrial estates that have a range of uses, so trade counter, warehouses, self-storage, gyms, manufacturing, some logistics. And, our retail is focused on convenience retail. So I think we're quite well positioned to weather a difficult period in the economy. So difficult to say, but I do think logistics is possibly looking slightly less shiny than it was at the beginning of the year.
Yeah. And Marcus, you obviously, you're pan-European, so are you seeing much disruption there at the moment? I know it's too early, but do you envisage it?
It is a little bit early, but we, of course, our job is to look over the immediate horizon. And the honest answer is that it's actually a tale of two cities. Things are moving in two directions. One is what we've already experienced for the last couple of years, or really since COVID, has been a lot more nearshoring and onshoring. We're invested through a number of European companies like CTP, WZP that have a lot of logistics exposure in Eastern Europe, And there we're seeing where land is plentiful, there is labour supply, and there we're seeing Asian and Chinese companies bringing goods partly completed and finishing the manufacturing process here. Now, previously that was because it was closer to market, as in to the European markets, but that may well lead to the fact that it's easier to get those assets over to the US as they've been essentially completed in Europe rather than in China. That's a possibility. At the same time, there is a general trend of a bit more just in time and a bit less just in case, i.e. you are, or vice versa rather, you literally are seeing an ongoing demand for warehousing and storage space. And in fact, we've already seen this in the very immediacy of what's been going on at the Canadian border, which is just an immediate impact of tariffs. So it's difficult to know. I agree broadly with Bradley's comment, but I think it may not be as big a game changer as one might expect. Obviously, a global slowdown is, of course, a much bigger worry for equities. However, of course, real estate's sort of dirty secret is that we don't really mind that a slowdown if it leads to a drop in long-term rates or the rates that we're financing off, because we're all owning leveraged assets. Whilst we would lose on a slightly slowing rental growth, we would benefit on the overall cost of debt, reduced. So in fact, we may find ourselves in an improved earnings situation if that cost of money was to decline.
Cool.
Yeah, just to add some balance, we've had two very slightly different views. Last time we were involved in a troublesome trade situation was immediately post-Brexit. And we were all told it was the end of the world. It's quite good for real estate. There was a lot of onshoring of supply chains. So I think that while we all saw the volatility around Trump's tariff war in the market, I think it was just blanket across the board. I don't think there was a great deal of light and shade in the way people were pricing all stocks in the market, because actually UK real estate, asset-backed, producing sustainable income and paying dividends out of earnings should be a great place to hide out in a global trade war. If you can tuck away a 7-8% dividend yield while the world clatters around your ears, I don't think any of us is suggesting that we're going to see wholesale tenant default on the back of a trade war and our earnings collapse. And if anything, as Marcus said, I think might be a dirty secret, but it's certainly an open secret. Falling rates are good for real estate.
Yeah, no, that's good. So we talked a lot on the macro side of things. A couple more, and then we'll get into there's lots of questions here on the sector fundamentals and a few for individual companies. So, but let's talk about. So we've got two generalist REITs. I'm not sure I like that term, but diversified REITs here. And there's a question here, and what are the merits of that versus the more specialist REITs? Bradley, do you want to go about that?
Yeah, sure. So I kind of alluded to it earlier when I mentioned, to probably many people's surprise on the call, that the strongest performing sector over the last 12 months has been shopping centres. I'm not suggesting we're going to go out and buy lots of shopping centres, but it just shows that the benefits of diversification there. And we can tack and change between sectors as we go. So a few years ago, we hugely increased our industrial allocation and have benefited as a result, and that's probably helped the share price performance I mentioned earlier. So it also enables you to pick out individual opportunities. So we're a very active manager. We undertake complicated capex projects. We look to grow income by repositioning assets. We're happy to take on property risk, and if we just focus on that, and the macro is important, but if we just stick to what we know and stick to what we can control, we can continue growing our earnings and continue moving that dividend on.
And Richard?
I think we need to slightly change the way we talk about these funds. We've been a diversified fund or a generous fund, call it what you want, specialist in regional property. I mean, you can call it anything you want, but there's an awful lot of euphemism. We're told about pure play funds. Now, to my way of thinking, that's a euphemism too far, because let's be frank, a single sector fund is a high risk fund. But it's also, when the market is with it, fund. High risk, high return. Single sector logistics, high risk, high return. Single sector shopping centres, until maybe this year, Bradley, high risk, terrible return. So the generalist fund, the diversified fund, just seeks to mitigate risk. And it did make us unfashionable for a period of time. But I think that as we have seen the collapse in property unit trusts, in the open-ended funds, so we are seeing flows of retail money into listed real estate. And for the retail investor, is it right and or appropriate that they pursue a high-risk fund strategy? Do they know when to get into one single sector fund and out of another? Or do they just want generalist property exposure? I think the answer is, and we're seeing it, Bradley said he's seeing it, strong retail flows into these funds. So the generalist fund really has a place, and that's been identified by investors, and we've seen share prices react on the back of that. But, we've got to start using the right language.
Yeah. Do you have any thoughts, Marcus, obviously, as a fund
Yeah,
of...
I'd add two comments to that. The first is that Richard's absolutely right. If you have investors that want to make that decision themselves, then a diversified or a funds that are spreading risk and through a cycle makes sense. For others, the easiest thing, and this is where, of course, you'd expect me to say this, where they could just buy shares in TR Property, because actually, when you look at institutional managers like myself, we prefer specialist vehicles. And if you look at the US market, which is the most advanced REIT market in the world, the largest and the most liquid, it is 95% specialists. And that's because their view is that real estate is an operational asset class, and that you actually need people who know as much as they possibly ever could about a particular market, and that whilst that particular REIT is therefore, as Richard points out, high risk, high return, depending on the point in the cycle, that allows the manager to pick and choose where he wants that exposure. So we like that. Now, that doesn't mean that there isn't a place for the diversified ones. That absolutely is. I think the difficulty for vehicles like Richard and Bradley's, and Bradley's made the point, is that shopping centres, large retail assets, are clearly something that one cannot dip in and out of. And I think that I probably would expect, if you could wave your magic wand, we would all want stamp duty to be 1%, which back to 1% of days of old, where that would allow Bradley and Richard's vehicles to rotate much more and capture the zeitgeist of a sector that's in demand, and allow them to rotate out of some assets that aren't. And certainly not these two managers, but there are others where I've been critical about how static the portfolios are. And I think you have got to do your best to get into those growth markets when they become available, and accept that there are some asset classes which are just going to be a struggle for some time to come. And the very obvious one with that is some low rental office markets, where the capital you've got to spend to bring them up to a EPC rating of B or A is disproportionate to the future returns from that asset.
Yeah. Okay, really interesting question here off the back of the discussion. So if we are at the bottom of the market, should REITs not be issuing shares at discounts to NAV to take advantage of these opportunities?
Yes,
What do you
they
think,
should.
Richard? Yeah.
They absolutely should. But unfortunately, investment trust rules preclude that without a shareholder vote. And because over the years, shareholders have been tutored that the key measure of worth is net asset value, they would consider issuing at a discount to be diluted, which mathematically it is. But if we could issue shares to buy property to enhance earnings, so we could pay higher dividends, clearly that would be a good thing to do. But we have tied ourselves up in a catch-22. We can't raise money at the very best time for us to raise money, and one would hope that the combined experience of this panel have all said, we think this is a great time to invest in real estate. We should all be out there raising money. But I don't, you look at our share price, there isn't sufficient demand. I don't think we'd raise the money that we could. So private equity are having all the fun.
So just to add to that, there are 2 points that Richard's made there. One is about the fact that the investor community have obsessed themselves about NAV. As far as I'm concerned, NAV is valuation is an art, not a science. It's the first thing, and therefore one shouldn't be as beholden to it as the market is. If we do look across at the pond, where they do not look at NAVs. Everything is earnings focused and therefore they're unconstrained. On Richard's second point about investment trusts and the rules, yes, that does mean that we need to move more of these companies to an internally managed structure and change their classification so that they are able to raise capital. As last week, 6 weeks ago, 2 months ago, Great Portland raised a huge amount of money at a big discount to its asset value. So it absolutely is possible. To Richard's third point, is there demand? I think as an investor, if Richard came to me and said, Marcus, I want to raise 200 million, et cetera, or 100 million or 50 million, what the number would be, I would want to look very carefully at the speed of deployment because of the impact of the cash drag. And I think what it's all about is, have you got a use for the capital, or is it actually just a veiled de-gearing exercise? Now, in the case of both Custodian and SREIT, neither of them need to go through a de-gearing exercise. They are not in an at-risk environment at all. But there are others who have done that. And we've seen mergers. So when we look at the acquisition of UK Commercial by Tritax Big Box, when Big Box owns boxes and UKCM was only half boxes, it looked like a ridiculous transaction to us from a strategic point of view, but it was an absolutely fantastic one for the Tritax Big Box, not only because they are externally managed and therefore they increased their AUM and therefore generated more fees for their third-party manager, but really it was essentially a veiled de-gearing. And that was the bit that the market may have missed, but not something that the chairman of UKCM had missed, because he realised the value of that balance sheet, which was why he resisted the rather abrupt sale to the Tritax. So yeah, the point here is we absolutely should be able to raise capital, and given the right messaging, it can be done.
And maybe if I could just weigh in, so there's been some discussion around internal versus external, and what I would note about external, so if we take SREIT, managed by Schroders, so the UK real estate platform in Schroders is 12 billion. We've got over 100 employees in the UK in real estate. We've got more than 30 front office staff in their markets, absolute specialists and experts in their markets. We've got a sustainability team of around 6, covering climate, net zero, data. We've got a research team, marketing team, etc. And all of that points at SREIT for a very reasonable fee of 0.9% on NAV. And we reduced that fee in 2021 by 18%. And our board and our manager are focused on best-in-class governance, and we would consider changes to the fee to show better alignment if that's what the market would like to see. The advantage of external vehicles, if they have an institutional manager, is just that huge amount of expertise pointed at the fund, and that's how we're able to manage a diversified fund in real estate.
Yeah. Okay, so let's get on with loads of questions here on the market in general and fundamental stuff. So I'll try and rattle through them. We've only got sort of 15 minutes left. So are you seeing changes in buyer or seller behaviour in the property market? Maybe Bradley, go first on that.
So certainly, early this year, there's been a dearth of transactions, and clearly because of the uncertainty around pricing and the outlook. But when you are going to market with assets, actually, the right assets get very heavily bid. So you can get deals done. But yeah, in general, this year, I just feel like there's been a real sort of wait and see approach.
And Richard, there's a question here for you. How might your exposure to offices evolve given the change in hybrid work patterns?
Well, I think the change in hybrid work patterns has been overstated. I think most people are now back in the office 3 to 4 days a week. And whether you need the office 3 to 4 days a week or 5 days a week, you need the office. And there's been really good stats recently of the significant take-up volumes and new lettings in central London and the big 6 cities, where there's extraordinary rental growth in offices. It's always been the most difficult asset class to own. It's always been about timing. It's always been the one that depreciates the fastest. So there's no real change there. I mean, for us, we have been active sellers of regional business park offices. We sold 2 in South Manchester just last week, a week before. And we have consolidated our holdings in core regional city centres, Manchester, Edinburgh, Glasgow, Leeds and Birmingham. and got out of town offices, because I think out of town offices is really, really difficult to drive rental growth. It's not where the modern office occupier wants to be. They want to be in city centres with high levels of amenity, good transport links, you know the rest. But the office market could just be one of the best performers. But that'll be short-lived because it's very cyclical.
Marcus, question here for you. What do you look for in potential portfolio companies? What are, like, say, the top 2 or 3 things that you need to sort of tick off the list?
The answer to that question varies between where we are in the cycle. And what I'm just wrote in the interim report, and I'll be now writing the final, is that really we've transitioned 9 months ago from focusing on the quality of the balance sheet and the refi risk back to market fundamentals, i.e. companies, for 2022 and 23, when you had this rapid change in the cost of capital, it was all about, who had the best quality balance sheets, who had their debt fixed longest, etc. Now we're back much more to market fundamentals. And therefore, where is the growth opportunity, and who has got the development pipeline, who's got the access to capital and to opportunities. But all of that ultimately blends into one key criteria, and that is a relatively small number of brains can really run an awful lot of real estate, certainly in terms of the strategic decision making. You then need a lot of boots on the ground to execute your strategy, collect your rents, engage with your tenants, etc. But that strategic decision, and really, so therefore, it does boil down to the C-suite and the quality of manager, and ensuring that they are themselves aligned through their LTIPs or through their contracts to ensure that they're aligned with shareholders.
Interesting. Cool. Bradley, what question here for you. Why do you have a majority allocation to the north of England and Scotland? Is there any reason for that, or is that just the way?
Yeah, good question and well spotted. So we have a majority allocation to the northwest. Cities such as Manchester, really vibrant city, and Leeds as well. So these are parts of that sort of big 6 that Richard mentioned earlier. And the reason is you can get higher yielding assets in those locations compared to the southeast. And where our investors want an attractive dividend yield and growing dividend yield, we need a certain yield in our investments, and we don't want to achieve that by buying poor real estate. We buy quality real estate in urban locations such as our multi-let industrial estate south of Manchester and Stanley Green, or on the edge of Leeds and Millshore Industrial Estate. Been really strong performance over the last few years. So really it's about yield, but also still able to get that rental growth as well, importantly. So it's really a yield play.
And Richard, what's your outlook for, it says high street here, but sort of what's your outlook for retail in general?
I'm very positive for retail warehousing. I don't think I'm alone in that. The Investment Property Forum consensus forecast supports the view that retail warehousing will be a good performer. It's heavily restricted supply and strong tenant demand. So I think we'll see some rental growth, and we are already seeing capital growth in that sector. The high street has polarized. So core prime high streets in cathedral city locations, ideally with universities, good tourist footfall, have always had, if we look across our portfolio, the lowest vacancy rates. Now, rental performance was pretty miserable for 5 years, but those rents have bottomed out. We're starting to see some rental growth in those core prime city locations. So I think there is some life in the high street. Secondary market towns, really, really difficult unless you enjoy owning charity shops. But otherwise, I would say that retail warehousing is the.
So, Marcus, what is the reason for maintaining a large position in London Metric? Is a question. I think you talked about them earlier.
Yeah, simple. Earnings growth. They are clearly a consolidator. And if they do bid the price that they have indicated and which the board of Logistics REITs is minded to accept, that's going to add further accretion. Ability to turn over the bottom part of the portfolio, which they are looking to continually positioning themselves into what they consider to be the growth parts of the market, I would consider, and the best-in-class EPRA cost ratio, all for us sits very comfortably with a large overweight position.
Got a couple here on Schroders low cost of debt. I think we've covered that and what the advantages are. So maybe I could ask you about whether there's any strategies in place to narrow the discount, Bradley.
Absolutely. So over the last few years, we've pulled a number of levers. We refinanced our debt in 2019, and that's paying huge dividends today. We reduced the management fee in 2021. We increased our industrial allocation over the last few years. Our investment performance has been very strong, so we've outperformed the benchmark by 4.9% per annum over the last 3 years. Clarified our strategy to be focused on improving the ESG performance of assets to generate higher rents and capital growth. And that, whilst I'm delighted it helps from an environmental perspective, it's purely because we think that would enhance total returns over the longer term. And we've seen some really good examples of that coming through. We have targeted retail investors over the last 3 years, and the proportion of the book, so maybe 3 years ago, was about 10% direct retail. We're now up to sort of 25% plus direct retail. So that marketing's really paying off. And we really have been, burning the shoe leather out, seeing institutional investors, asset tours, doing everything we can to beat the drum, because we think we really do have a really compelling proposition. And as you've heard from the panel, we think it's a really interesting point in time for UK real estate now. So, we have been working really hard to bring that discount in. We were at single digits earlier in the year. We'd love to grow the vehicle through whether that's new equity or through consolidation, but the key is to do that. You need to bring that share price rating up, and that's what we're working hard to do.
And Richard, this one was directed at you. I think what strategies are in place to narrow that discount?
Well, I suppose the question that is being asked is, perhaps the question is, would we consider buybacks? Buybacks, in my experience, have not really delivered for those that have followed that strategy. And when I look at the opportunity set in front of me as a manager, buyback shares, we're cancelling a 6 pence per share dividend. Yet we can invest, and indeed are widely investing across the portfolio in solar PV that's delivering us 15% return. So to cancel a 6p dividend and then not have sufficient funds to roll out solar PV doesn't feel like a very sensible exchange for what might only be a short-term shot in the arm in narrowing that discount. So now I'm putting my faith in the recovery that we can see around us, and my hope and expectation that is going to be a more widely held view.
We're sort of coming towards the end now, and we haven't discussed Achilles. But there is a question here on Achilles, and I know, Marcus, you supported Achilles in their capital raise a couple of months ago. So I just wanted to get the panel's thoughts really on do you think the sector, there is sort of a governance issue here, a wider sort of governance issue, and do you think boards can do more for shareholders? Maybe start with Marcus.
Thank you, Richard. Just to clarify, we are not investors in Achilles itself. They approached us and invited us to join them after their success with PRS REIT. And the message to them and to all our investors is we've essentially been doing what Achilles are doing, but just quietly behind closed doors in discussions with boards and managers of companies that we own, where we have significant stakes, and where we are constantly helping them understand why the market is rating their paper as they are at a particular point in a cycle, and trying to help them understand what they can do and how we can help. However, we did join alongside Achilles in the requisitioning an EGM to remove the chairman and the SID and the manager of Urban Logistics REIT on the back of a preposterous internalisation proposal that was absolutely at a humongous detriment to shareholders. It had a 12-year payback. It was utterly insane. And, when the lunatics are running the asylum, you have to, as owners of the business, you've got to stand up and step in. And that's what we did. And then during that period of disruption, obviously you saw the board and the manager of London Metric come forward and take advantage of that situation. And we think if that comes to pass, that will be the right outcome. But to answer the question, is there improvement for governance? Yes, there are in certain places. That is a very good example of very poor governance. There are many examples of excellent governance as well, but there is always, in some respects, room for improvement. Every chairman and every chief exec only has to answer a very simple question: is their behaviour aligned with the interests of shareholders? And I think, Richard's point about buybacks, his argument is absolutely correct on one side of the coin. The other is that as a shareholder, one is sitting in the back seat of the taxi. And, therefore one is trusting the manager to do the right thing. And everybody bleats about our NAV is £1 and our share price is 70p. Well, if you really believe that pound, there can be no better investment, not from an earnings perspective, but just from a sheer return on asset value per share, than buying your own handcrafted portfolio at a 30% discount. What happens, though, is that managers don't really believe their asset value, and therefore that gap isn't as large as you might think. So, but that doesn't take away from Richard's point, which is a very valid one, about the future earnings opportunity of that pound. And I would say that's why we don't encourage companies to buy back when they're trading on 10 or 15% discounts, because that's exactly the issue that arises. That there is a better opportunity with that money. But when the discounts are very wide, absolutely you need to do that. Now, in the case of Achilles, just finishing on Achilles, on the case of PRS REIT, they were dead right to go after PRS REIT, where again the board, or in this case the chairman, unilaterally granted a contract extension unnecessarily to the manager, who then sold that contract to a business based in Singapore. So it was a very pure example of where an external management structure was monetized to the detriment of the owners of the company. That and for Richard and for Bradley, just bloody annoying, excuse my language, for them to have to endure, watching some bad apples make a poor case for external management. Whereas I just want to be clear, there is absolutely a case for external management. No problem with it at all, as long as we have that alignment. Sorry, I rather hogged the microphone, but it was a question about governance.
Yeah. And so what's your thoughts on that, Bradley, then?
So first on the buyback point, when our share price discount was sort of 40% plus in the midst of the pandemic, we did do buybacks and it was accretive. Whereas now when our discount is sort of 10, as Mark said, 10 to 15%, it's just not as obvious a case. We are challenged on it by a board. I think we've got an excellent board. Governance is, like I say, they aim for best-in-class governance. Same with the manager. Excellent experience on the board in property, in M&A, in finance, in risk and control, etc. So I think that, I like to think that SREIT is a really good example of where it can work well.
And maybe final word with Richard
On Achilles.
Yeah, on that sort of the governance issues and
Yeah, well, clearly, governance is very central to what we do, and I think for the most part across the sector, governance is pretty good, and I think, but it does only take one or two rotten apples to sour the whole barrel. But I think we broadly get it right. I take Marcus's point on the buyback, and I suppose it says a lot about the way we manage the fund, that I'm not that focused on NAV, and I am very focused on earnings. So my answer perhaps belies that focus. We are absolutely dedicated to growing earnings, and I think in the long run that'll see us right. But in the short run, there are times when people might have been critical that we didn't buy shares back. Happily our discounts only been really wide for very short periods of time.
Yeah, great. Any final words there, Marcus? I think
the only final one on governance is, when I look at the UK versus many parts of Europe, the UK has an astonishingly good governance structure. So the few bad apples that Richard referring to are modest in a wider context, and we certainly have some extraordinary situations in some European supervisory boards who see themselves as very much just literally that, offering very high level supervision, whereas I think all the various codes of conduct, etc., and improvements in boards, particularly on the investment trust side, with the help of the AIC, etc., shows that the UK is very much best in class. So we absolutely shouldn't give ourselves too hard a time on this at all.
Cool. All right. Well, thanks a lot, guys. We've run over by a couple of minutes, but very interesting discussion, and we seem to be at a very good, interesting time in the market, and hopefully we will see those returns coming through over the next year or so. But yeah, thanks a lot for your time again, and we will hopefully have you back on again soon, a year or so down the line, and see how it's all gone. But just leaves me now to talk about what we got coming up next week. So I just wanted to highlight this AIC initiative, My Share, My Vote campaign, which we will we encourage you all to sort of sign up to. It's very important, especially recently that we've seen with the cyber attacks on investment trusts and things. So we feel that's very that's a key campaign to be getting behind. So we there's a link on our website where you can look at all the information on that and how to get involved. Next week we have Andrew McHattie talking about what's happened in the investment trust sector over March. Over April, and we got Nick Brindon, the manager of Polar Capital Financials Trust, as our guest speaker. So we hope to see you back again next week, and enjoy your weekend. Thank you.